Good morning and welcome to this Wednesday, November 10th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we've seen a little bit of weakness so far this week. Market's pulling back a little bit. This morning, market's going to get a little bit more of a test because the CPI came out a little hotter than expected. We're going to talk about that in just a couple minutes. But yeah, I mean, futures definitely, well, they were last time I looked, and it's been a little while. So let me just get a quick glance at them. But I know futures were down this morning. Let's see. Yeah, this is a little bit on delay, but you got Dow Futures down 77, S&P down 18.5. And clearly the bigger loser on a relative basis this morning is the NASDAQ, where we see futures down about 115 points. And I would expect that. I mean, if there's any kind of an inflation scare, whether it's short-term, longer-term, whatever, those high-growth companies on the NASDAQ are where we are likely to see a little bit more in the way of profit-taking in the near term. We've had a big run in the market, so I'm not overly surprised. And I talked about that earlier this week, that I just feel like we're probably entering a period where we're going to be a little bit more choppy. We've had a huge run in the market, went through a historical period where we typically see strong action. We've seen it again this year. And so I wouldn't be expecting a whole lot of a big move. I think we'll still get another push into year end. But I think it'll probably come closer to the end of this month would be my guess, and then into December. Of course, second half of December, we tend to see really solid action in the market. All right, so let's go ahead. Let me take you over to Earnings Beats first. Let's get this thing started. Got a couple of announcements over there. First, just want to let everybody know we do have an event coming up this afternoon. It'll start at 5:30 Eastern. This is a members only event. So if you are interested and you're not a member, we have a 30-day no cost trial. So you can come on board 30 days, don't have to put up a cent. If you like our service, great. We'll have some great opportunities for you to join. We've got our fall special starting later this week. If you like it, you'll have opportunities there. If you don't like the service, if it's not really a fit for you, no fuss, no muss. Again, no cost. But it is coming up 5:30 today. This is our earnings reaction portfolio. So this is something we had our inaugural first quarter the last 90 days. It actually ends today. So at the close today, that portfolio, our earnings reaction portfolio, will have ended its first 3-month period. We'll take all those stocks out and we'll add 10 new stocks this afternoon to that portfolio. So it's one that we just started recently. I'm really interested in it just to see how it performs, because it's not based on whether the companies beat top and bottom lines. That's typically what we look for. This one's simply based on, is Wall Street buying after the earnings report comes out? So from the opening bell after a company reports to the closing bell, what does a stock do? We look at the best ones over the entire quarter thus far. And based on those candlesticks and based on other technical factors, we put together 10 stocks, equal weighted in the portfolio. So if you'd like to be there for this tonight to get a sense for what we do in putting these together, we'll talk about the results for the last quarter. Sign up for our no-cost 30-day trial. We'd love to have you. Also, just want to point out, as I always do, anyone who's new to Earnings Beats and you really just want to start to get a little taste of what we do, I would strongly suggest that you take a look at the Earnings Beats Digest. It's our free newsletter. Comes out 3 times a week, Mondays, Wednesdays, and Fridays. Normally, we're delivering it by about 8:30 in the morning, so maybe about an hour before the market opens. Very, very quick read. It's a couple paragraphs and a chart typically. But it'll at least allow you to see some of the things that are important to us at Earnings Beat. So I look a lot at relative strength. I look at earnings reports. For the most part, I like to trade companies that have recently beaten Wall Street estimates. And for me, it just comes down to I was a practicing CPA for 20 years. And I just like the fact that that management teams are executing. I feel like there's less chance over the next, couple of weeks or a couple of months, however long I want to trade a stock, I think there's less of a chance that a company is going to come out and report some kind of bad news, or they're not making their numbers when they've just recently beaten Wall Street estimates, and many of them have raised guidance. So I just think that that's a better way to trade the market. That's my own personal opinion, and it's really factored into our service. But this Earnings Beats Digest kind of gets you set up for some of the things that we look at. I think it's a really great newsletter. Certainly worth the cost of admission. As I said, it's zero, no credit card required. You can unsubscribe at any time. So check that out. We are getting pretty close to our next portfolio draft for our 4 major stock portfolios. We do this the 19th of every February, May, August, and November. And well, November 19th is 9 days away. And we're actually doing it this year on, or this quarter on November 18th. We're going to do it the day before because that's a Thursday rather than do it on a Friday night or over the weekend. So we're going to be doing it on Thursday, November 18th. But if you haven't checked out the performance of these portfolios, if you don't believe that leading stocks in leading industry groups works, I would encourage you to check out these results, because that's how we put these portfolios together. Each portfolio, every quarter, 10 equal weighted stocks in typically 10 different industry groups. But then we'll weight things a little bit more towards, say, technology or consumer discretionary when we believe we're in a secular bull market, which I think undoubtedly we are in. So, but you can take a look at the since inception numbers and see how we've done. I mean, it's not even close. We've been crushing the S&P 500. This quarter, our model portfolio is trying to make a run for the S&P. It was lagging by about 5 percentage points a week ago, so it's making a pretty good comeback. But look at the aggressive. I mean, it is just dominating the S&P 500. The strong AD, same thing. These are 1 quarter results, not even 3 months yet. And we're talking about outperformance by 12 percentage points, 17 percentage points, big numbers. And we've had a history of doing this. Doesn't happen every quarter. We had a really horrible quarter back February to May when growth stocks went out of favor. So I'm not trying to say this is anything that's going to, is the perfect investment every quarter. But I think over time it's done pretty well. And these numbers certainly back that up. Anyhow, let's move on. I want to talk a little bit about what happened yesterday. So we've had this huge run up, and you can see a little crack in the foundation with the action yesterday. Dow Jones down 112 points, S&P down 16, NASDAQ down 96. That was down about 0.6%. So that was the biggest loser, if you will, among the major indices yesterday. Mid caps fell 4 points, small caps 4 points. Both, well, actually all 5 of these, though, are pulling back slightly from all-time record high territory. So I think overall we're getting some great action in the market. And to be quite honest, we went from 4,300 on the S&P to 4,700 in a month, maybe 5 weeks. It's okay to pull back and have a period of selling. I'm always talking about the secular bull market and how I'm very, very bullish. That doesn't mean the market goes up every day. And I wouldn't be surprised now that we've had this big run up through the first week of November. I wouldn't be surprised to see downward action, maybe even down to that 20-day EMA, which would be another, 70 points or so, about 90 points. So that could be maybe 2 more percent. Wouldn't surprise me. That's typical during any kind of an advanced pullback and test that rising 20-day. So maybe be on the lookout for that. As far as sectors go, yesterday it had nothing to do with the aggressive groups. Aggressive groups didn't do much. Utilities led, up 0.5%. Materials up 0.46%. Energies 0.41%. We had real estate 0.37%. So you can see it was defensive groups. It was those neutral materials and energy. Those areas of the market did well yesterday. Discretionary, worst performer. You can see down almost 2%. But discretionary had gone straight up. I mean, it went from under 180 at the beginning of October to over 210. That's a sector, an entire sector going up 30 points. That's a really big move. So this is normal profit taking. And today, as I mentioned, I'm going to get into the inflation report, but CPI came in hotter than expected. That's going to be an excuse to sell a lot of these stocks, take profit. So don't be surprised to see some of these aggressive groups have a little bit of a rough week. All right, let's move on to the 10-year Treasury yield. So this morning, got a couple of reports. First, we got a report on the initial jobless claims. That normally comes out on Thursdays, but tomorrow is Veterans Day. So it was released a day early. Initial jobless claims, not a problem, 267,000. Market was expecting 271,000. So we were a little bit below that. We were also a little bit below last week, which was 269,000. So initial jobless claims continue to show that the job market's been strengthening, which we already know, coming out of the pandemic and so forth. But that continues to get better and better. So that's good news. The October CPI expected to rise 0.5%, rose 0.9% this morning. And if we just look at the core CPI, so we're stripping out food and energy, the expectation was a rise of 0.4%. We rose 0.6%. And that core CPI is a number that the Fed will focus on much more strongly. If you recall, last month I was talking about how the annual rate of inflation at the consumer level is starting to roll over. Well, we might have to readjust that because we just came in higher than expected. That may start to turn back up again. Either way, I can promise you we're going to see some headlines because the market's overbought. We need to come down, need to, take some profits here. And so you're going to see more and more headlines, just the way the market works. And as the market falls back, there's going to be even more reports how we're going into a bear market and the inflation is going to be out of control. Let me just tell you, up until now, we've been dealing with this for months. And up until now, the market's not showing any signs on the charts of being worried about inflation. I mean, you don't get bond yields down at 1.4% and dropping from 1.7% when you're worried about inflation. If you're worried about inflation, you're selling bonds. You don't want to hold bonds yielding 1.5% if inflation's 5%. If that's going to be a long-term issue, I mean, doesn't that just make common sense? Yay, I just made 1.5%. Oh, but I lost 5% in buying power. Makes no sense. You don't want to be in bonds. So the bond market's been sending us a signal that inflation is not a long-term problem. Is it a problem right now? Is it increasing? Yes. Could it increase further? Yes. Bond market saying it's not going to be a problem down the road. And that's what I'm focused on. All right. So that's the 10-year Treasury yield. You can see, let me give you an update. Just make sure we get the latest here this morning. So it is up, which I would expect with inflation being higher than expected. So we are up 5 basis points to 1.48%. Still in the downtrend. We'll see how things, I wouldn't be surprised to see this move right back up and possibly even close to the 170 level. Quite honestly, I think this is going to be an opportunity probably for financials and industrials if we do start to move back higher in the yield. So some of the technology stocks that you've seen huge runs on, Tesla, my gosh, what a huge run that's had, but it's pulled back a couple hundred points now. If you haven't been watching the last 2 days, Tesla's been hit pretty hard, but it broke out above 900, if you recall. And let me just go ahead and show you that chart right now. So here was that move up to 1250, but here was that breakout above 900 coming across. So could we go back into the 900, 950 range? Yeah, got gap support, price support, 50-day coming up. Closer it gets to that level, though, the better the reward to risk on entry, in my opinion, is. So if you've been watching Tesla and you're like, hey, I can't jump in, this thing's been going straight up. Well, here's your chance. It's coming back down. I would be accumulating on this weakness personally, and I am. Let's see. How about let's go over to talking technically, and let's look at the S&P 500. So here's the S&P 500. You can see the rising 20-day. When we get into these, moves where we start really taking off, kind of like we did back here in, I guess it was November and into December. You can see the S&P that PPO really expanding to the upside. Normally, when you pull back, sometimes you get these intraday breaks below the 20-day, but you can see we held this for a few months and just rode the 20-day. That's what I'd be looking for here personally. We broke out above this 45.40 area. So, maybe there's an outside shot. We go down there, but I'd be looking at the 20-day, which right now is sitting at 45.87. That would be about 2% on the S&P moving down. So from a daily perspective, that's what I would consider just a normal pullback. On the 60-minute chart, yeah, this was earlier this week. I think it was on Monday. I said, hey, if we move to a new high, you could see that that PPO was starting to be impacted by the weakness. Here we kind of went sideways. We didn't really pull back much. Here we pulled back a little bit, but this one we really started to come down. And so Monday, we didn't get to a new high, but we threatened it. And you can see the PPO never even turned up. And so that's just telling you in the short term, momentum starting to get a little weaker. Doesn't mean we have to go through a huge sell-off. I mean, look at this period. I mean, we went down and all we did is went sideways. So maybe we just go sideways here. Maybe we hit the 50 and then we hang on and turn back up later and go back to new highs. It's possible. So on the hourly chart, what I'm looking at is possible weakness down here to the 50. You could pull up a couple of different levels if you annotate, like this breakout here, which would be down at 46.35. That's where we broke out back on November 3rd. You got this breakout right here where we kind of went sideways for a day and then made the breakout. We haven't broken down below that. And then that the 20-day, now this isn't the hourly chart, but that 20-day that I just talked about was at 45.87. So let me just kind of draw where that would come in at roughly. It's probably right at right there somewhere. So those are, three levels, this being the daily support level. And then here's a couple levels on the hourly chart. You got the 50. If I'm sounding like, hey, you're not really telling us anything, it could go anywhere. Well, it's pretty much true. The market can go anywhere it wants. But these are levels I'd be looking for. I think I believe we're going to have a little bit of selling here, especially now with the inflation report coming in hotter than expected. It just gives the market reason to sell off. I think we'll probably go back down and test that 20-day EMA. I wouldn't be surprised to see us move back below 4,600 and test that level. I don't know if it'll happen right away, but trending lower for a period of time wouldn't surprise me. So that's something, maybe back toward the middle part of October, see how we were trending lower, something like that. I'm not expecting big drops, but I wouldn't be surprised to see close to 100 points come off the S&P. We got up over 4,700. And like I mentioned earlier, it came from down near 4,300 just a month ago, a little over a month ago. Actually, that wasn't even a month ago, October 13th. So you get a move like that, you've just got to expect that we're going to see some weakness from time to time. All right, so let's move on. I want to show you a little bit behind the scenes what I do at Earnings Beats. So I want to talk a little bit about scanning and just the process that I go through in terms of my own trading, in terms of, what I provide our Earnings Beats members through the daily market report. Some of the things I talk about in the Earnings Beats Digest newsletter, our free newsletter, things I talk about here on these shows, things I write about over in my blogs at Stock Charts. How do I come up with those ideas? And I write about it. So if you've been reading my blog articles or listening to shows, you probably have a pretty general sense, but I'm going to walk you through, kind of a big picture down to individual stock level. So I'm going to start off first with the consumer discretionary area, because if probably it was maybe right in here. So it was probably in September, I started talking about the consumer discretionary group and how I really believed that it was going to move higher and that it was going to outperform. And there were a couple reasons technically for it, but there's also historical reasons behind that. I've been studying the S&P 500 for many, many years. I probably really started putting numbers on a spreadsheet back in the 1990s, where I went back to 1950 on the S&P 500. And I wanted to begin looking for trends in the market based on the calendar. How much of a role does that play? And the reason that this all started was when I was working in public accounting in the 1980s and 1990s, I would audit companies and I'd look at payrolls. And I noticed most of our clients had payrolls that offered 401k plans, and they would withhold money from employees' salaries, their paychecks, and then they'd ship it off to Vanguard or Fidelity or 20th Century or one of the big funds. And I always thought, well, these fund companies are getting this money and they have to invest right away. They don't, wait and decide when the market's right to invest. They invest when they receive the money. They're obligated to do so. So, when I went back and I looked, I noticed that, a lot of the companies I audited were paying beginning of the month and middle of the month. Either I had some companies that would only pay once a month. I had many companies that were paying twice a month. First of the month, middle of the month, whether it was the 31st, 15th, 1st, 15th, 1st, 16th, whatever. But that seemed to be the majority of the company. So I wanted to take a look at the market historically just to see when or how the money flows impacted the stock market. What I found was amazing. The 26th of the calendar month through the 6th of the calendar month, all calendar months, those 10, 11 days account for 90% of the gains in the S&P 500 since 1950. And I found, a lot of other things, but I track a lot of history. One of the things that I also track is when we're in secular bull markets, I like to see what the sectors do and which sectors lead in a secular bull market. Well, once you do that study, you realize it's not even close. It's technology, it's consumer discretionary, and it's communication services. Those are the three big ones. Now, the other outperformers are financials and industrials, but to a little bit lesser extent. But all five outperform the S&P 500. So with that knowledge, I look at, something like the XLY and XLK, technology, XLI, industrials, all of these, I look at on a relative basis to the S&P 500 all the time. And what I saw here was a bullish wedge on the XLY. So you got the highs coming down, the lows are coming down, but not at the same pace. So you get the squeezing piece of pie. And I see a lot of people use these bullish wedges at bottoms. I don't like them on bottoms. For me, you need to be in an uptrend to use a bullish wedge. I don't like using a bullish wedge when it's going lower. And when it's like, if this was tilted and going from up here to down here, and I saw this pattern, it would mean nothing to me. But at the top of a pattern, these squeezing patterns, I think, are very important when you make breakouts. So we had this breakout occurring, and the breakout occurred in September, probably early part of September, after we had tested support. And also look at this. I got to show you this. This is one of the coolest things as I was going through. I'd never even looked at this until probably last month or two. I'm always trying to learn something about the market. But I happened to notice that this relative PPO, whenever we got to this -1 level, that would be about the time that we would see consumer discretionary take off and crush the S&P 500. You can see these moves. I mean, every time. So here we are again, printing this double bottom at the -1 level, just like we did in the pandemic. And look at it taking off again. So keep that in mind for 1 second, because I'm going to show you the next chart, which is industrials. Now, I didn't finish. I think I was running out of time here, but let's get the weekly chart up. I can get this set up pretty quickly. Actually, I can just do it over on this chart. Let's just change this one to XLI. All right, so let's update this. All right, so now we're looking at the XLI. Couple things. First thing I would point out is look at the PPO. Look at what we're doing on the PPO right now. There's that -1 level. And you can see, with the exception of the pandemic, which I think we can all say is kind of a one-off type of an event, -1 is just about where we start to see industrials start to move higher. Now, it doesn't seem quite as strong as discretionary, but still, when we hit these levels, we tend to have a pretty strong bounce. We're right there right now. So if interest rates go up in the short term because of inflation, industrials tend to outperform when rates are rising. We've already gotten the breakout in transports. We know historically industrials love the month of November. We have a lot of things lining up here. So when I look at that, I start thinking, okay, I want to start overweighting my portfolio with industrial trades. I should be able to find some pretty good ones. So from there, I'm going to go into the dashboard. And I mean, you can do this a variety of ways, but if you go into this area right here, your scans, and click on this more button, it'll show predefined scans. And then you can kind of figure out what scan, predefined scan you might be interested in. I don't want 52-week lows. I don't want stocks that are going down hitting 52-week lows. I want, I'm more of a momentum kind of a trader. But I might, let me see, what do I want to do here? No, I don't really do the point and figure. I'm trying to think if there's, I mean, I could use the 1-day patterns, that might set up some stocks for pullbacks. But I think probably what I would do is just maybe move to like the new 52-week highs. These are going to give me pretty good indication. If you're an industrial right now, again, look at the, well, I already changed, no, there's the chart. Well, industrials, you can see on a relative basis. This is candlestick. Let me just at least get rid of the candlestick here. So you can see that over the course of the last few months, industrials have not been performing well. So if you've got an industrial that's setting a new 52-week high, that's a pretty good stock. I mean, without thinking anything else, if it's setting a 52-week high while its group is doing not well versus the S&P 500, that would tell me something. So what I would do is click on one of these, and then this is the New York Stock Exchange 52-week highs, but you can click here to edit the scan. So a lot of times what I'll do is I will put in something like, I'll just add something. So I'm going to do an or. So I want it to be on either. Yeah, I want it to be in either the New York Stock Exchange or exchange equals NASDAQ. And then I double bracket it. And the reason you have to double bracket it whenever you have an or, the scan engine has to know or which, is it just 2 things you're doing an or? Is it 3? Is it 4? Well, here we're just doing 2. So we just double bracket the or clause. And then, then we can go back to that and there's the rest of it. Now, what else do I want to change? Anything else? Well, I want stocks. I want New York Stock Exchange. I want NASDAQ. Here, the volume, I want to make sure that the 50-day volume is at least 200,000 shares. I just like a little bit more. And then this is just saying the daily high is greater than yesterday's daily max, 253 days. So we could change this. We could say, well, how about if we were looking for an industrial maybe that's just gone up and set a new high over the last 90 days? That might be worth looking at. And then what you can do is add, you can come down here and the sectors, add a sector. So, and it's also got to be part of the industrial sector. Add that. So now it can be on either exchange. It's got to have this kind of volume. It's setting a new 90-day high, and it's in the industrial sector. Run the scan. 32 of them, very manageable list. So what I would do is I would dump it into a chart list. I would put this, I can just replace an old scan results folder or something. Well, here's a good one, scan results industrials. Let me just put it in there. And from there, I can then view these candle glance and then maybe just take a quick look at something that might, look at this breakout right here, GE. And GE gapped up. They announced they were splitting into different segments, companies, and you can see the pullback after it gapped up. But I think GE looks pretty strong for a potential run here. Eaton Corp just recently broke out above a top. Fortune Brands getting very close, move through 105 would seem like a pretty good move. HDSN, I know most companies, I don't even know HDSN. Volume's picking up, and it's a $4 stock. Maybe that's something that's appealing to you. Here, a lot of sideways action on Jacobs Engineering, making a move. Let's pull up Jacobs, look at it, and then we'll move on to the earnings because I'm running out of time here. But here's Jacobs. Look at the sideways consolidation, just making a breakout after all this. Then you could maybe even go in and look at the seasonality real quick and look at J and see what it does in November. Go back 20 years. Okay, it's okay. It averages 5% during the month of November, which is the best of any. So it does like the month of November, but it only goes up 60% of the time. But that might be further confirmation. That 5% best month of the year is November. Maybe that's a reason to say, hey, I'm going to ride with Jacobs Engineering this month. Or maybe you wait for a pullback in the stock. There's a lot of different things that you can do. Anyway, let's go on to earnings. I just want to point out a couple. Yesterday, oh my gosh, there were so many earnings reports out last night. But DoorDash came out, had a nice report. Also, let's see if I can move this a little bit. There we go. Let me do this. Market's going to open here in about 10 seconds, but DoorDash up $33. They actually beat. They were expected to lose 30 cents. They lost 27 cents. Then you got a company like Unity Software, which matched expectations. Not good enough. This was actually a company I put in the EB Digest this morning. Let me go ahead and pull this chart up, and then we'll move on. Actually, I'll do the three you must see as 3 earnings reports so we can wrap up sooner. But look at Unity, and I can step this out to 2-year chart. And you can see it went public a little over a year ago, but this 175 area is major resistance. We tested it going into earnings. That's a time to sell, in my opinion, just my opinion. I don't like holding stocks into earnings for the most part. And if I do, I generally will trim my position down quite a bit because it's just so risky. I don't want to leave my entire trade at risk. You know, I could be up 10%. I could, literally at the announcement, drop 20%. And all of a sudden, I got a great winner that turns into a loser, only because I wanted to, roll the dice. Some of you, maybe you like that, but it is the most risky time to do it. Anyway, there's Unity. You can see it's at 160. Now it might go down, probably will go down to the 20-day and hold, but it's probably going to be very volatile in the short term. Company that beat, that was looking really good last night after hours, was Ring Central, 36 cents versus 33 cents, stock up 29% today. Now, I don't like chasing them because I don't know if this is going to be a black candle, which would suggest further weakness ahead, or if it's going to be a hollow candle, which then would make today's open extremely important from a support level. But I don't know until I see the action today. So jumping in at this level, it's literally you roll the dice, flip a coin. That's the way I feel about it. Wynn Resorts yesterday reported a loss that was bigger than expected. Currently trading down $1.50. They were expected to lose $1.17. They lost $1.24. Let me give you 3 stocks that reported, and I'll use these as the 3 you must see. So the first one I'll pull up is Plug Power. This is in renewable energy, and I think the stock looks pretty strong, but earnings came in worse than expected. They were expected to lose 9 cents. They lost 19 cents, but the overall group is hot. So this isn't going to be one that's going to be on our strong earnings chart list, but it's going to probably be in a strong future earnings chart list, because if Wall Street keeps liking the company, it keeps trending higher, it's probably because the market's expecting the next 90 days to be better than what we just saw. Anyway, Plug, I think at the 20-day looks very interesting. It's also very risky. It's very volatile. A second company that reported, Docs, they had 19 cents versus 10 cents expected. Go back to a 1-year chart here. So we did gap down. It's been trending lower. AD line also has been going lower. I think it really needs to hold on to this support, 65. You do have gap support at 60 right here from pretty solid volume. I'm pretty sure that was an earnings related gap. So 60 could actually set up a positive divergence. If we go below this low, hit 60, we'll be at gap support. We'll also have a positive divergence on the PPO. So that's the second one. Third one, Alcon, ALC, and then we're going to wrap this thing up. 54 cents versus 49 cents. Stock gap down, but you can see rallying, trying to put in that hollow candle. Breakout above about 87.5, I think, would be very bullish for Alcon. And on a relative chart, wanted to point out that versus the healthcare providers, it bottomed probably 6 months ago, been trending higher, came out with a pretty decent report. I'd like to see this relative strength right here hold, but you can see the group itself is broken out. So it's in a pretty good group. AD line very strong, which means it tends to close better than it opens. And we're seeing that so far today if it finishes like that. But look for a breakout above 87.5. That one looks pretty good. All right, let's get a quick update, see what the market's doing. I would expect that we're going to see a little weakness this week, maybe in the next, and then maybe pick back up again after that. Just my gut feeling. Here you can see NASDAQ getting hit harder, which makes sense when you got the CPI coming out the way it does. So I'm not surprised. The NASDAQ's been leading. I believe this is going to create another opportunity for those who want to get into NASDAQ stocks, but we'll see. Dow only down 0.1%. So some of those stocks actually performing pretty well today. So it's more about growth stocks in the short term. Even small caps, mid caps holding up better than the NASDAQ. We'll see if that continues. All right, that's it for me, everybody. Have a great day. Remember, At 5:30 today, we have the earnings reaction portfolio draft. I like to call it the draft because, hey, we can pick any stock we want. You know, I love these drafts. It's like being in the NFL, except you get the first 10 picks. You know, you ought to be able to build a pretty good team. So that's what we're going to be doing at 5:30 today. Hope you can make it. If not, next show, or even if you can, next show I'll do is tomorrow over at Stock Charts TV at 9 a.m. That'll be your next Trading Places Live. Listen, everybody have a great day. Be careful out there. Things probably going to be a little bit rough in the near term, but we'll try and walk you through it. Happy trading, everybody.